So here is the long strangle position. Back on June 22nd, we opened a far out in time, August 19th. So we were essentially 60 days out in time when I opened this position in June, Dave. And the stock was the ETF, was trading right at about 370. This actually was a roll from a previous one where we had, I think, a 415 call and a 395 put. When the stock was down at 385, sorry, the ETF, Dave, was down at 385. We took the profit off of that strangle and moved it to the current one at 395 and 355. I was very skeptical about this one for a long time. No, that's why you're seeing a negative cost basis here on my August 395 calls, because that was taking to the profit from the previously rolled position. Even though we paid, I think it was $8 for this, we've taken in over $11 in profit over the months by moving the strangle up and down. And now is looking like a pretty good time where I might want to consider liquidating this or rolling it. In other words, we're going to sell to close the 395 call. Let me go back here. Sell to close the 395 call for 1961 and sell to close the 355 put for 24 cents. And we're going to re-bracket the collar. And typically what I've been doing is if I did it today when the stock was at 411, I'd still want to go another 40 or 50 days out in time, depending on cost, to give myself more time for fluctuations to occur. But where I'd likely roll to is somewhere around a 0.35, maybe 0.4 delta. I think 0.35 to 0.33 is where I've been settling. This one was 0.3, and that's why it made me nervous, because it wasn't seeing as much traction in the first 2 weeks as some of the other ones did. I think it was too far out of the money with a 0.3 or 0.28 delta. So I'm going to probably go back to maybe a 0.35 or a 0.4, but that's going to be more expensive for closing this position out and rolling to the next one. So what I might typically do at this point is let's go to SPY. Now I have a search. This is the webinar account, but I have a search set up just screening against SPYs for deltas between 0.38 to 0.28 on the call and the put that are certain range date out in time. So I usually would just use that long strangle search, Dave, against SPY just to find that. But let's take a look at our chain. And we can walk through setting that search up as well. September, yeah, might use a quarterly. It's 63 days out, but I'd probably just use September. Standard expiration, September 16th. Take the profit off of this particular one, which is including also profits from the other previous transactions. And I'd probably be using somewhere in here. I'm thinking maybe the 400 to 398 put. Jot that down. And I think this is my delta. Yeah, this has got to be my delta column. Sorry for the scrolling, folks. That's got to be my delta. And maybe somewhere in here. That's really bullish. But yeah, that's where I'd probably want to be. Maybe 425-ish to 427. So it's pretty widespread. Not actually too wide, but that's what we would be looking at in that case. So while I'm here, let's just do that. Let's clear out the previous position and see what that would look like, Dave. So back in the profit and loss chart / custom spread tool, I'm going to go to September 16th expiration. And I'm going to use the lower range. I'm going to use the 425, 400. This is not a recommendation or suggestion. This is just probably how I build the position. So I'm going to use that 400 put instead of the 397 or so, and we're going to use the 425 put instead of the 427. So that's pretty expensive. Volatility has been declining. So what we're going to do, we're just going to buy a call out of the money, buy a put out of the money, run a 0.3 to 0.35 delta. Yeah, $1,200 per contract, $1,300 per contract, $1,340 almost per contract. And that's what we have. We've got this no man's land at break even at 386, but that's all the way at expiration. I'm looking more for profits in between now and September expiration. 824, probably a decent target, actually, but we still need to be a significant move. Where are we at? 391, reasonable. 433. Not so reasonable, in my opinion. Okay, but in any case, can you get a better risk-reward profile by going closer to the money? Maybe buying a 415 and a 400, or maybe buying a 415 and a 407, for example. You're going to have a higher cost, which means the potential for higher risk, but you'd have a higher lower break even and a lower upper break even before the position started to get to profit, either at the halfway point or at the end. So that's how the strangles work. You go further out of the money, you pay less. If I went to a delta of 0.25 on the strangle, Dave, we'd be further out of the money. I'd be buying a 430 versus a 390, let's say, just for example. But that means the stock would need to move further. I'd have a much lower break even and a much higher upper break even because the stock needs to move more. My cost would probably only be in the $809 range per contract instead of $1,300 in that case. Sorry there. Lost my train of thought. It'd be a lower cost, of course, but the break evens would be wider. And if you go closer in, just like you had mentioned a straddle position, I think in your previous email today before your discussion with Ernie, Dave, a long straddle will have a higher cost basis because you're buying at the money and paying into the most time premium at the time. But that means that you have more cost, more loss if the stock doesn't move, but your loss only occurs at the maximum loss, I should say, only occurs at one point in that case. And Victor, your follow-up question, on this long strangle, how much profit or profit percent are you looking for? Or are you just looking for a peak or bottom in the market based on your own judgment? It's both. And I hate to say it because you know as well as I do what this SPY has been. Let's go year to date. There we go. And so I started this with a smaller portion of my portfolio here. I didn't pick the bottom, and this one was a good profit right away, so I rolled it out to here. And this stagnated. Thankfully, I got another small profit here, and then I realized, Victor, I was doing it too short. So the next time I rebracketed, I went out to here. It was here. Okay? And I rolled it. I did not pick the top. No, I didn't. I rolled it here because I felt so I took the profit on the call here, profited small amount on the put here with the loss in the call, had a good return here. What return? As cost of the strangle goes, I was looking for the 80%, 85% along those lines. And so when it did here, I rebracketed against, we rebracketed here, gave up some profit, and we went out to here. No, I went out to here. That's May. I know it was May. And I rolled this one twice, I think, during this time period. This most recent one was done somewhere in this time period. No, I'm sorry. It wasn't. It was done nearer to the bottom here, and that's the position we have on right now. This is the one, remember, was at 370. That's right, when I said, I have that in the notes on that position, Victor. It was around 375, 378 when we rebracketed to the current position that we have open, which is the 395, 370, 355. Oof, so low. It was so expensive at the time too, because it had dropped down to 370 and 375, and the implied volatility was high. And I'm glad I didn't actually buy a 360 or 365 because that would have been in the $12 range, and I wouldn't be seeing much profit at all. So really, if you look at it, this profit is not that high on this individual position. And that changed too, Victor. What do I mean by that? The initial position, 680 and 830, it was 1510 to get into the strangle. And, right now we're at a profit of, we've got 19. So we're a $4 profit, of course, on 15, roughly, is what we're looking at here. I'm not counting the extra 24 cents, Victor. So that's a very small percent. It's not small, but it's not the target I'd normally look for. It's 26, 27%, not in the wheelhouse I would like, but the position as a whole, because my effective cost per share is not 680 on this long call. It's a negative, a credit of 388 because of the previous rolls, Victor, that we've done. I'm sorry, I did not erase those drawings. I sincerely apologize, ladies and gentlemen. There we go. All right. So, Victor, it's a little bit of both, to tell you the truth. And the reason why you don't hear me give a direct example of this, I'm sorry, Victor, that's a terrible, terrible thing. I've shown you direct examples. Why I'm not going into direct specifics like I do with the bull put credit spreads is because I've been playing with this for 4.5 or 5 months with about 2 or 3% of my portfolio. It's not concrete. It's like a little lottery ticket, but I realized that bull puts and bear calls, if this market was going to be as choppy as it was not going to help. What is going to profit in wild swings? Well, longer on one side and long on the other side to take advantage of it. The answer to me was a strangle position. I didn't want to do the straddle because the high volatility, high time value by buying right at the money. I wanted to do them out of the money strangles. And I don't have a full format worked up yet because I know I've made mistakes, as I just mentioned. When I realized that those first couple ones I did, although they profited, they were too short term. I needed to start looking further out in time to give more time for the fluctuations to occur. And no, I don't have perfect market timing. This one was close. I'll admit that. That was close to perfect market timing. The other one I mentioned over here wasn't perfect, but I at least was able to salvage some of the profits that we had on the calls from when we moved it out to here. And then we still took advantage of the big downturn at some point. It's probably, yeah, that looks about right. When it breached 400, it was probably right at 398, 399 when I moved it out. And then here we rebracketed again. I'm still, I'm still at that 60, 65 day out range, Victor, but I won't hold them all the way to expiration. I'm rolling more when you're right, that percentage target is hit, or if I see something that changed. Much like what Chuck mentioned, I think in his discussion of what strategy you're trading now, or that was Jim, wasn't it? It might have been Jim A, where he was talking about riding a particular, seeing a change in the trend would give him indication that, oh, this is when I wanted to move to bear calls. When you saw a trend continuing, riding a certain Bollinger Band, but then it shifted. He says, oh, I might be doing bull puts now. Got caught, maybe, unfortunately. But Jim was only doing 5 day out trades where I was doing the 14. Setting up the long strangle screen for what I look for to help me roll to a position. I may just use the custom spread tool as you saw, Victor, but in general, let's clear out the filters. All expirations. I'm going to use all expirations, and I'm going to go about 40 to 70 days out in time. Now, I narrow this down a little bit more because SPY does have all those different weeklies, but usually this is a good range where it's more or less standard expirations. And what I'm going to do is look for a I apologize. I'm going to use a delta, the call delta of less than 0.36 to probably no more than 0.24. I might do 0.25, but I've got to have a very strong movement on the long strangle position. Now, put delta, you got to go reverse. It's negative. So I'm going to put delta of greater than negative 0.36 and less than minus 0.24. Okay. And then what I'm going to do is go to my lists. So I have it on this one. There's SPX. Oh, shoot, I don't. So I usually have a list created for just SPY, as you can see, just for QQQ, just for SPX. But so for this case, we'll just use the search by symbol, which doesn't save. That's why I use the list, because it's always saved. That's what it is on my main account. And go to submit search. Oof. Stock option combinations. I'm pretty sure I have that right. As far as that goes, let me change the expirations to, let's just do this, 20 to, maybe I do have it backwards. My apologies. Take a look here. There we go. Okay, I did have it set up right. So again, 33, 31, 21. I think I just had a poor expiration date selection. It was looking just shorter term ones. I don't know why I'm not seeing the farther out ones. But I'll look into that later. But in any case, it should be perfectly fine. Because I should be able to see September's. I don't know what was going wrong with that first one. But in any case, this is what I'd use. And it's close to what we were looking at, isn't it? Here's a 425, 403, a 425, 402. That's pretty close in the ranges. So now that I know I'm going to close mine, Victor, I have this search saved on my account. And when I'm looking to roll, I'll just pull up what the new ones are with my delta range of 0.23. I don't have the delta here, but on my actual account, instead of the webinar account, I do have the deltas of both. So I'll look at those also as well. Okay, fantastic. So that's how you'd set up the search. It's usually best to create the list because when I save it with the list, it saves it, and then I can come in and look for what I wanted here for just the delta range. And that's the, let's just take a look at that 425, 402, very similar to what we saw on our other position. Cost of only $950 though. I think we were looking, we were looking at a cost of $1,300, was it? We were doing the 425, 405, I believe. Was it that much higher? Yeah, it was a 425. I can't remember off the top of my head, but in any case, that's very similar to the structure we're looking for, kind of right in between or close to it. I do like to have a balance, just for me personally, Victor, meaning that, hey, if I'm 425, what am I? I'm roughly 14 points above. To keep it the same, maybe I would use the 395 put, just so I'm 15 points away one way or the other. It's almost even, and what we call the percent out of the money range, meaning I'm close to equidistant between the two strikes when I open the position. It just makes a clearer chart for me when I first open it, but I know it's going to be different later on. Delta is important, though. I try to keep the deltas about the same, which usually keeps the strike difference away from the current stock price the same when I'm looking to roll to that out of the money long strangle position. Okay, Victor, sorry, I promised and mentioned that we were going to do that. And of course you did. We didn't really review it too much. Where is it? There we go. But you can customize this any way you wanted to. If I just wanted to use range or number of strikes out of the money, the percent out of the money range helps me narrow in so I'm not too skewed to bullish or bearish. It's really important to use for me for iron condors, or if I was doing short strangles instead of long strangle positions. And yeah, I do normally additional things I look for is I look for some volume, but it's never a problem with SPY or QQQ. But yeah, usually I put in a volume requirement or maybe an open interest requirement as well.